Are you ready to take your investment strategy to the next level with some of the most promising index funds available today? From high-growth tech firms to reliable dividend payers, the versatility of index funds can cater to a variety of investment appetites, offering both safety and growth potential through diverse market sectors. But how do you pick the right ones that align with your financial goals and risk tolerance? Stick around as we dissect the top features, benefits, and performance metrics of 6 standout index funds. Without further ado, let's get into it. 6. Fidelity Zero Large Cap Index Fund. It's an enticing option for investors seeking exposure to the US large cap market with minimal fees. Unlike traditional S&P 500 index funds, FNILX tracks the Fidelity US Large Cap Index, a benchmark designed to mirror the performance of the 500 largest publicly traded companies in the US. This approach allows Fidelity to bypass licensing fees associated with the S&P 500 index, resulting in a key benefit for investors, a 0% expense ratio. When it comes to their fee structure, it makes it a cost-effective way to invest in a diversified basket of large, well-established companies. This can be particularly attractive for beginning investors who may have a small sum of money to start or who are looking for a low-maintenance investment option. The fund requires no minimum investment to get started and offers daily share pricing, providing flexibility for investors. While past performance isn't a guarantee of future results, FNILX has delivered competitive returns. The fund boasts a 10.56% return over the past year, 9.70% over the past 3 years, and 10.99% return over the past 5 years. This generally aligns with the performance of the broader US stock market. One of the main advantages of FNILX is its focus on large cap companies. The fund's current sector allocation leans heavily towards technology, around 32%, with significant exposure to financial services, healthcare, consumer cyclical, and communication services sectors as well. Interestingly, the index fund is classified as a large blend fund, indicating that it invests in a mix of value and growth stocks. Value stocks are typically those believed to be trading for less than their intrinsic value, while growth stocks are companies with the potential for high future earnings. This blend can offer investors a balance between income and capital appreciation. 5. Schwab S&P 500 Index Fund. This one caters to investors seeking a low-cost, diversified way to participate in the US stock market. And not just any stocks, but manages and tracks the S&P 500 index. A key advantage of why you should consider it is its exceptionally low expense ratio. At just 0.02%, it boasts one of the most competitive fees among S&P 500 index funds, significantly reducing the cost of investment compared to actively managed funds. This translates to a larger portion of your returns staying invested for potential growth. As expected for the S&P 500 index, SWPPX's performance is directly tied to the index's movement. In 2022, the fund mirrored the S&P 500's decline over 18%, reflecting a challenging year for the stock market. However, in 2023, it rebounded alongside the index, delivering a total return of approximately 26.25%, nearly identical to the S&P 500's performance. The fund's holdings directly correspond to the S&P 500 composition. Major holdings typically include industrial giants like Apple, Microsoft, ExxonMobil, Johnson & Johnson, and JP Morgan Chase. The fund's sector allocation also aligns with the S&P 500, with technology, financials, healthcare, consumer cyclical, and communication services forming some of the most prominent sectors. This diversification helps mitigate risk by reducing dependence on any single industry. Another attractive feature of SWPPX is its low minimum investment of just $1. This makes the fund accessible to a broad range of investors. allowing even those with limited capital to participate in the US stock market. 4. Vanguard Growth ETF. This exchange-traded fund tracks the CRSP US Large Cap Growth Index, designed to mirror the performance of leading US companies with high growth potential. A key advantage of it is its low expense ratio of 0.04%. This competitive fee structure translates to more of your return staying invested for potential growth compared to actively managed funds with higher fees. Vanguard, a well-established investment management company, oversees VUG, which was launched in January 2004. Today, the fund boasts net assets exceeding $226.52 billion. As with any investment tied to a specific market segment, VUG's performance is directly linked to the performance of large cap growth stocks. While past performance isn't a guarantee of future results, VUG's historical returns are noteworthy. For instance, the fund's average annual return of over 5 years, before taxes, surpassed 19% as of December 31st, 2023, exceeding the S&P 500's return of less than 16% over the same period. This strong performance can be attributed to the recent surge in technology stocks, a sector heavily represented within VUG. The fund's holding reflects its focus on growth-oriented companies. Major holdings like Microsoft, Apple, Nvidia, Amazon, and Tesla are prominent examples. As of today, the fund holds over 208 US large cap growth stocks. Technology accounts for nearly half of the funds, around 47.63%, followed by consumer cyclical, around 15.67%, communication services, around 13.46%, and healthcare, around 7.52%. The fund's geographic allocation is primarily concentrated in the United States, almost 99.8%, with minimal exposure to other developed markets. Financial data like VUG current price sits at $342.78 with a price to earnings (PE) ratio of 41.26. The fund's year-to-date daily total return is around 10.41%. Its beta of 1.20 indicates that VUG's price movement tends to be 20% more volatile than the overall market, again reflecting the inherent volatility associated with growth stocks. Another noteworthy feature of VUG is its low minimum investment, making it accessible to a broad range of investors. Unlike some funds with high minimums, VUG allows investors to start with any amount, enabling participation in the growth stock market even with limited capital. 3. SPDR S&P Dividend ETF. This exchange-traded fund takes a unique approach by following the S&P High Yield Dividend Aristocrats Index. It specifically targets companies within the S&P Composite 1500 index that not only boasts high dividend yields, but also have a history of consistently increasing their dividends annually for at least 25 consecutive years. By following this index, SDY offers exposure to a basket of dividend-paying stocks with a proven track record of dividend growth. One of the key attractions of it is its attractive dividend yield. As of January 22, 2024, the fund's 30-day SEC yield sat around 2.59%, significantly exceeding the S&P 500's average yield of roughly 1.46%. This translates to potentially higher income generation for investors focused on building a steady stream of income from their portfolios. There is a trade-off, however. The expense ratio for SDY is 0.35%, which is higher than some passively managed index funds. This fee eats into your overall returns, so it's important to factor this cost into your investment decision. SSGA, a global investment management firm, oversees SDY. The fund was launched in 1993 and has grown to hold over $63.2 billion in net assets as of today. Looking at the fund's holdings, you'll find established companies like 3M, Realty Income, International Business Machines, Target, and ABVI Inc. These are just a few examples, and the specific holdings can change over time. As of today, SDY holds roughly 121 companies, a smaller number compared to broader market index funds. This concentration in a select group of holdings can increase risk compared to a more diversified fund. The sector allocation of SDY reflects its focus on high dividend yielding stocks. Technology stocks, which are known for lower dividend payouts but higher growth potential, are underweighted in this fund. Conversely, SDY has a significant allocation towards real estate investment trusts. This makes sense, as REITs are required by law to distribute at least 90% of their taxable income to shareholders, leading to typically higher dividend yields. The current sector breakdown shows an underweighing in technology, around 4.2%, and an overweighing in consumer staples, around 14.3%, utilities, around 12.1%, and real estate, around 19.2%. The fund's geographic allocation is primarily concentrated in the United States, around 82.3%, with some exposure to developed international markets, around 17.7%. 2. Vanguard Real Estate ETF. Well, this one caters to investors seeking a low-cost entry point into the U.S. real estate market. At 0.12%, it boasts a highly competitive expense ratio compared to actively managed real estate funds. This translates to more of your returns staying invested for potential growth. With net assets exceeding $65 billion, VNQ is the largest real estate index fund, signifying investor confidence in its ability to track the real estate market. VNQ tracks the MSCI US Investable Market Real Estate 2550 Index. This benchmark index focuses on equity real estate investment trusts, companies that own and operate income-producing real estate. While the index also includes some real estate management and development companies, REITs take center stage. This focus makes VNQ appealing to dividend-seeking investors. As REITs are required by law to distribute a significant portion of their taxable income to shareholders, their current 12-month dividend yield sits around 4.07%, offering a potential source of regular income alongside capital appreciation. Beyond income generation, real estate is often viewed as a hedge against inflation. Undoubtedly, VNQ can be an attractive option for investors worried about rising prices. Real assets like real estate tend to hold or even increase in value during inflationary periods, potentially protecting investors' portfolios. Looking at the fund's holdings provides insight into its investment strategy. Vanguard Real Estate 2 Index Fund, Prologis Inc., Industrial, American Tower Corp., Cell Tower Real Estate, Equinix Inc., Data Center Real Estate, and Well Tower Inc., Healthcare Real Estate, are among the top holdings. These established companies with growth potential showcase VNQ's focus on diversified real estate exposure. It's important to note that the 2550 in the index name refers to its inclusion of both large cap and mid cap REITs, but excludes smaller cap REITs. 1. Vanguard Russell 2000 ETF. Now, this one dives into the world of small cap US stocks, offering investors a chance at significant growth potential. Launched in 2010, VTWO has grown to over $8.8 billion in assets, solidifying its position as a major player in the small cap ETF arena. It tracks the Russell 2000 Index, a benchmark for the performance of the US small cap segment. By following this index, the ETF grants investors broad exposure to a basket of small cap companies. As of December 2023, the fund's holdings were heavily concentrated in industrials, around 18.4%, financials, around 16%, and consumer discretionary sectors, around 13.3%. One of the key attractions of VTWO is its low expense ratio of 0.10%. This competitive fee allows investors to keep more of their returns for potential growth compared to actively managed funds with higher costs. It's important to remember that small cap companies, though offering their potential for high growth, also come with increased risk. These companies typically have a market capitalization below $2 billion, making them more susceptible to market fluctuations. Looking at the top holdings of VTWO provides a glimpse into the specific companies in which the ETF invests. Some examples include Supermicro Computer Inc., Light & Wonder Inc., and Rambus Inc. While past performance isn't guaranteed for future results, VTWO has delivered positive returns recently. Year to date, as of March 20th, 2024, the ETF has gained around 0.73%, and over the past year, it's up roughly 19.76%. These returns come with a slightly higher level of risk compared to the overall market, as reflected by VTWO's beta of 1.14. A beta exceeding 1 indicates that the fund's price movement tend to be more volatile than the market. Anyway, the standard deviation of 22.97% for the trailing 3-year period further confirms the inherent volatility associated with small cap stocks. So now, which one of these index funds resonates most with your investment goals? Which among them are you choosing and why? Comment down below. Also, leave a like, subscribe, and don't forget to turn on the notification bell.